Many people spend hours each day creating complex and foreboding investing strategies. The harsh truth is most of these strategies never come close to beating the market. However, there is an easier and safer way to invest your money without overcomplicating anything. In fact, you only need to invest in 3 funds to not lose out against the market. And it's so easy that even a monkey could do it. You heard that right. In this video, I'm going to go over 3 funds that cover both the stock and bond markets that can make you a millionaire over the years. Basically, the 3-fund portfolio contains a domestic stock index fund, an international stock index fund, and a bond index fund. Try saying that 3 times fast. I'll talk more about which stocks to pick for each broker later. The idea of this portfolio is to be diversified in the market with low time commitments. Since this strategy is a passive investing strategy, it's considerably cheaper than an actively managed fund. And let's face it, since you only have to invest in 3 funds, it isn't super complicated. The first benefit of the 3-fund portfolio is that there's no overlap between the assets. Because each section of the portfolio is different from each other, there are no 2 sections that contain the majority of similar stocks. Overlap exists in a portfolio when 2 or more funds have the exact same stock. For example, if you own the S&P 500 and the QQQ index, 2 popular index funds, there would be an overlap with the FANG stocks, or commonly known as the tech stocks. An overlap like this could decrease diversification as there would be too large of a concentration in just a few companies. In general, if we decrease diversification, we increase our risk, which makes for a more dangerous and volatile investment. And that's not something you want if you want a portfolio that takes almost no time to manage. Investing in only 3 funds seems extremely easy, doesn't it? It makes you wonder if you have to pay a large premium to make sure these funds are going to be successful. Luckily, you don't, as this strategy is extremely cost effective. Since you only need to invest in 3 funds, you don't need an advisor or manager controlling your stocks and taking a cut of your profit. Not to mention, the stocks that they control may not even beat the market. On average, an actively managed fund takes about 1% of your investment in the fund each year. With these funds, there may also be a lot of trading going on, which can cause higher tax. One study from Goldman Sachs found that only 32% of actively managed mutual funds have historically beaten the market. But with all the extra costs, it probably isn't worth it compared to a passive fund. Most passive funds boast much lower expense ratios, usually around 0.6% or less. And let's say you have some money in a mutual fund with a 1% expense ratio. Over 30 years, you would lose out on $48,625 over the years. That's a considerable amount of money for the chance of beating the market each year. And consistently beating the market every year for 30 years is slim to none. When I first saw this number, I was actually caught off guard by just how much money you would have to pay in fees. Since these funds are constantly trading and don't have to report it immediately, it's also hard to figure out why your money is going up or down, whereas investing in just 3 funds gives you the same result with much more transparency. As transparency is really important, I do want to tell you guys that if you like the content, a sub to the channel would mean a lot to me. In funds without transparency, there could be a considerable amount of advisor bias, which can greatly alter the growth of a fund or portfolio. With the 3-fund portfolio, that doesn't exist because there's no advisors controlling what you get. For example, if you have an advisor that is adamant that tech is going to go up and invests heavily in tech, that mutual fund is now much riskier due to a factor that's outside your control. Knowing what you invest in makes it as clear as water to see if your investments start getting riskier. And as the 3-fund portfolio invests in 3 different funds, it's really hard to lose that diversification and increase risk. Each part of the fund is broadly invested, which means it's invested in the entire market rather than a specific sector or group. The actual index funds we're going to be investing on are considerably low risk and don't move around like a dog off a leash. The 3-fund portfolio can be made riskier for investors who want to take the chance with larger returns. I'll mention the exact numbers later, but basically, the more you invest in bonds, the safer this portfolio will be. This portfolio is not meant for quick monetary turnarounds just like other safe investments. It's mostly a buy and hold strategy besides when you need to rebalance it. Buying and holding allows the portfolio to be considerably tax efficient as there aren't too many transactions going on. You can further minimize the tax on when you need to rebalance by putting the portfolio in a Roth IRA. As the funds contained in this portfolio don't have a large dividend yield, there isn't much tax to be paid on those either. Minimizing the tax we have to pay on investments is really a key thing to look out for, as no one likes to see all the money they just made just to have a large chunk of it siphoned away. The main reason anyone would even consider this portfolio is its simplicity. It's really just a 2-step process of figuring out which stocks to get for each broker, and then rebalancing it about once a year. And it's absolutely phenomenal when you can't spend every waking second watching your portfolio. There's no advisors to keep track of, no large fees to watch out for, and no random events that'll target this portfolio only. Obviously, it's not immune to market crashes, but if there is a portfolio that is, I would love to know about it. In my opinion, the amount of time and effort required to maintain the portfolio definitely makes it one of the best long-term investing strategies. Like I said earlier, the more you invest in bonds, the safer your portfolio will be. And so a very conservative asset allocation would be around the lines of putting 15% of the funds into the domestic stock market, 5% into the international market, and 80% in bonds. As you can see, this allocation relies heavily on bonds, which will get you a much safer portfolio at the cost of returns. On the contrary, an aggressive approach minimizes the investment in bonds, having only 15% in bonds and 85% for the stocks. This approach would suit younger people better, as they can hold their portfolio for a longer period of time. The last group, or a moderate risk portfolio, have bonds taking up just under half the entire portfolio. Take a look at this. If you invested in only stocks over the last 12 years, you would have a max drawdown of 34%. And it's been even worse in the past. That means if you had $100,000 invested, at one point your portfolio would have been valued at $66,000. If you were able to handle this, you would also have an average annual return of almost 11%, which is really good. On the other hand, investing in only bonds would give you a 1.8% average annual return, with a max drawdown of about 18.5%. That's almost half the max drawdown of the aggressive asset allocation. Now for the part most of you have been waiting for, which is which funds to actually pick. All you really need is one stock for the total US index, one for the total international stock index, and one for the total US bond index. Now, at the top of this chart, you can see the Vanguard ETF funds, and these are available on any broker. Usually, the broker-specific funds are cheaper, and that's why they're also listed. The rest of the funds on this table are also mutual funds, and not ETFs. But don't worry, the mutual funds are not actively managed. Now, if your portfolio distributions get uneven, that's the time to rebalance. Ideally, you should only be rebalancing about once per year, as there's no real need to do it more often than that. Let's say you have a portfolio with $15,000 split evenly across all three funds of the portfolio. And if US stocks grow to $20,000, now there isn't an even distribution across all of the funds. In this case, the US stocks are about 66.67% of the portfolio rather than the 33% they used to be. The other two are at 16.7% each. Because the entire portfolio is now valued at $30,000, to be evenly split, each fund needs $10,000. Here, we would sell off the $10,000 from the US stocks and distribute the profits across the other two sectors. And now the portfolio is rebalanced. Keep in mind, when you do this, you may have to pay taxes when you sell the stock. To make sure you don't lose any money while performing this strategy, make sure to watch this video about the worst investing mistakes. If you guys like this video, make sure to subscribe to my channel for other similar videos. I'll see you guys later.